with some tax planning, or maybe just some sort of prospective financial planning in that sense on how to best plan for these specific types of assets. And especially over the last couple of years, there's been some pretty significant changes in the law on how those accounts are dealt with from an inheritance standpoint. But before I dive too much into detail on that, just a couple quick things to go through. This is an interactive webinar, so you can submit questions to the Q&A function, and I'll see that come up and be able to answer those questions as we go along. Just keep an eye out for an email after this as well, the email you use to sign up. You'll get a couple of things from us. You'll get a handout, which is actually a good summary of these law changes with retirement accounts that I'm going to be talking about. So it's a sort of pre-rule change rules versus post Secure Act change rules. And sort of you can compare and contrast how those differ, especially for the payment terms and payout terms for your beneficiaries on those accounts, as well as some of the changes that occur during lifetime as well for you as the account owner. And then just if you are interested in attending our upcoming sessions as well, our next week, we're going to be talking about like keeping, maximizing long-term care protection for you and making sure that the retirement assets that you've built up, that you can do some protection planning for. So if you're interested and or concerned about long-term care expenses, please feel free to sign up for that as well. And then the following week on March 15th, we're going to be doing our Wills versus Trust public seminar. And that will be at the Bordini Center through Fox Valley Tech here in Appleton. There are 2 sessions for that, 2 p.m. and 6 p.m. If you're interested in attending that, that's our kind of big overview of all of the topics of estate planning, long-term care planning, wills, trusts, powers of attorney, all of those topics. Feel free to sign up for that at estateplanninglive.com. And you'll also receive a feedback form at the end of this through your email that will allow you to sign up for an initial consultation. We do offer complimentary initial consultations. We schedule them for about 2 hours. We can't reach out to you unless you fill that in. So if you want us to set aside time to meet with one of us, please feel free to fill that out, especially if anything I talk about today or just general estate planning questions. But if any sort of questions come up that you want to have, one of us in our office talk to you about and set aside time to meet, please feel free to fill that out. And again, that'll come in an email at the end of this. All right, so talking about retirement accounts and maximizing the value of these, as I mentioned, there's been some pretty big changes in the law over the last 3 years now, give or take, but we actually had a very recent update to this law as well. Although that changed less of the things that we're going to be talking about today and added some slight changes on the age of required minimum distributions, and then some other minor changes as well. So I'll be focusing primarily on the bigger changes that occurred under the previous version of the law that changed things for inherited IRAs specifically. So that law change, you may have heard of this, was called the Secure Act. I apologize, I don't remember exactly what the acronym fully stands for, but it's Setting Every Community Up for Retirement Act, I believe is what it stands for. Congress loves their acronyms. But what this law changed was things on the side of how long beneficiaries have to take out these accounts, so from an inheritance standpoint. And also when you, as the original holder of this account, have to start taking your required minimum distributions, and as well as some other things as well, like how long you can contribute to these accounts if you're over a certain age, things like that. So what it changed, what the old version of this law changed back in 2020 was that it upped the age of required minimum distributions from 70 and a half to 72. And that is actually now being upped further under what they're calling Secure Act 2.0. Eventually, it will phase upwards up to 75 as the age at which you have to take required minimum distributions. Initially, it'll be 73, and over the years, it will increase up to 75. So that means that you don't have to take out your required minimum distributions as early. And that sounds great, right? Initially thinking, well, I don't have to take out my pre-tax income, pay tax on it earlier than I would otherwise, want to. Maybe I want to wait until 75 because I don't like to pay taxes on things. And, you're right that initially that sounds great, but the problem with that is that your life expectancy is still using the same table as it previously did. So if you have to take out required minimum distributions based off of your life expectancy, the shorter your life expectancy, because you're now older when you start taking them out or have to start taking them out, the larger your required minimum distribution is going to be, the higher of the percentage of that account you have to take out will be, which means potentially more taxes being paid on it, maybe a higher rate of taxes. So it sounds great to think, well, I can delay these taxes further, but if you do get to that point and you have to start taking out required minimum distributions and you haven't been doing tax planning previously on those accounts, that just means you're going to have a larger amount coming out at any given time pre-tax that you have to then pay taxes on. So it sounds great initially thinking, oh, I can wait longer to take these required minimum distributions. But if you're not careful, it could mean that you're paying more in taxes in the long run. So it can be worth looking into a couple things to potentially plan for that. And I'll talk more in detail on that after I talk about some of the other changes that these laws introduced. So previously, under the pre-2020 changes, when somebody inherited an IRA from like mom or dad, a child inherited their parents' IRA, they would have their life expectancy to take out the distributions from that account. Now, they didn't get to wait until 70 and a half, like the owners of those accounts did under the prior versions of the law. They had to start right away. But what that meant is they could still, like as a 50-year-old, have a 50-year-old's life expectancy to draw down and pay taxes on their portion of that account. So you could stretch out those taxes quite a ways and have potentially a pretty minimal impact on taxes if you were really stretching it out that long. Well, under the first version of the Secure Act, that actually changed that payment down to a 10-year stretch at most for most beneficiaries. So now most beneficiaries inheriting an IRA, a 401k, 403b, any of those types of retirement accounts, whether they're traditional IRAs or Roth IRAs or whichever type they are, those individuals now have most of the time no more than 10 years to take out those distributions. So we've gotten some more guidance on what that looks like, and it looks like that people are going to have to be, in addition to taking it out by the end of year 10, fully liquidating that account by the end of year 10 for the beneficiaries, they're also going to have to be taking required minimum distributions based off of life expectancy during that time for pre-tax accounts. So most people are going to be accomplishing that by maybe stretching it out 1/10 every year, but at the bare minimum, they're still going to have to take out a life expectancy tables, required minimum distribution over that 10-year time. So 10 years, though, is a lot shorter than a lot of beneficiaries would have had under the prior versions of the law. A 50-year-old using a 50-year-old's life expectancy would have had a couple decades to take out that account. Now they're down to one. And that's a much shorter period of time, especially the younger the beneficiary is. Now, there are some exceptions to that 10-year payout, but for the most part, when we're talking about beneficiaries, most of people don't fall under these exceptions. Now, a common one that somebody's going to fall under for that 10-year rule is a spouse. So a spouse can still roll over an inherited retirement account as if it were their own, which is what most spouses would do. And therefore they get their own, they can still wait to take required minimum distributions until they hit the actual age of required minimum distributions. They can get a life expectancy stretch on it at that point too. So that's what most spouses would do. But if you're not a spouse and you're inheriting an IRA or 401k, in order to fall under an exception to that 10-year payout, you either have to be a minor child of the original owner. So, not just a minor in general, but a minor child of the original owner. That minor child will get a life expectancy stretch until they reach 18, and then they'll have 10 years to take it out at that point. So they could wait until potentially 28, right, to liquidate the account, regardless of how much younger than 18 they started. So that's one exception that is less common, just because when people are passing away, more commonly their kids are adults when that's happening, but some people would fall under this exception. Another exception would be somebody with a disability according to the IRS. So if somebody has a disability where they are on like SSI, for example, maybe they're receiving Medicaid, they can fall under an exception to this 10-year payout as well and use a life expectancy stretch for themselves. So depending on who you're planning for, you might be able to stretch out the taxes on that IRA for beneficiaries longer if you're, if you have beneficiaries who have some sort of disability that is preventing them from being able to work and engage in gainful activity, right? Which is how the IRS defines that disability. That's the second sort of exemption or exception rather to that 10-year payout. The weirder exception is one that I've actually seen come up more frequently than I would have thought. And that is if somebody is not more than 10 years younger than the original account owner, they can also use their life expectancy to stretch out that retirement account that they've inherited. Initially, it sounded like a very niche exception to this 10-year payout of, well, most people are going to be leaving things to their kids, right? So how often is that going to be the case? But I've started to see a lot of, clients who don't have children maybe are leaving things to their siblings or to family friends who are similar in age to them. And they tend to be pretty close in age where, yeah, they might be within 10 years of age on the younger side, or they might even be older, which is not more than 10 years younger. And those people can have a life expectancy stretch on it. So it can be what seemed like a very niche exception is actually becoming something that I've seen more frequently than maybe the disability exception, or even especially the minor child exception. This not more than 10 years younger exception is something that you can use to your benefit, especially if you have some beneficiaries that are siblings and others that are maybe nieces and nephews. You might plan differently for those assets because you're trying to stretch out the taxes for as long as possible for those beneficiaries. So there are exceptions to that 10-year rule, but you don't want to rely on them for tax planning because you just don't know initially whether or not somebody would fall under that exception, especially like the disability exception, unless you know it's a disability that won't improve, right? But if you're trying to think, well, maybe somebody could have that problem, it's not a good idea to plan for the potential disability that somebody has when it comes to like tax planning. You want to know that that's something you can plan around. So how do you deal with these increased tax payouts, the 10 years versus a life expectancy stretch, if somebody doesn't fall under one of those 10-year exceptions? And one of the ways to look at this and also to plan for that later RMD age now is to look at potentially doing some Roth conversion planning. So what a Roth conversion is when you yourself pay tax on a portion of your pre-tax retirement account and shifted over post-tax then into a Roth version of that account, so a Roth IRA. The nice thing about that is you can, if you're planning far enough in advance, especially before you have to start taking required minimum distributions, and especially before anybody inherits those accounts from you, you can plan tax-wise and only pay as much tax as you want initially. Only move as much as you want based off of what your tax bracket might be. And you would work with an accountant and your financial planner on this to figure out what that amount would be, what the best strategy would be on this. But if you can move more and more of that into a post-tax account, well, the benefit for you during lifetime is you don't have to take required minimum distributions on a Roth account. So you can move more of that post-tax, kind of picking and choosing how much of that to move any given year, and then have less of a tax burden on yourself when you do hit that required minimum distribution age. Especially now that eventually it will go up to 75, we know that this could be a really, a lot larger of a required minimum distribution percentage than people were used to under the prior versions of the law. So the more these individuals can get post-tax by prospectively doing some tax planning and converting some of these accounts over to Roth versions of those accounts, the better off they're going to be tax-wise when it comes time to take required minimum distributions. And the strategy doesn't work for everybody. I mean, this is why you have to talk with your accountant, why you have to talk with your financial planner to look at these sorts of things, because tax-wise, it might not make sense for everybody. but for a lot of people, it does. And so it's worth having the discussion and figuring out, well, if I'm, in my mid 60s, maybe I'm on Social Security now, I'm on Medicare, but I am not at the age I have to start taking required minimum distributions. Does it make sense for me to willingly pay some of the tax on this at a much lower rate than I might otherwise have to when I start taking required minimums out? The benefit for your beneficiaries, of course, is they also don't pay tax on a Roth account. They still have to take it out over 10 years. They have a set period of time to take it out, but they're not paying tax on it as it's coming out. So the more you can shift over into a Roth account for the beneficiary's sake, the better off they're going to be, because then they won't have to pay tax on it either. Now, I have plenty of clients who say, well, that's their problem, and that's something they can deal with. Fair enough. I mean, nobody can force you to do the Roth conversions, but the math tends to really work out in favor of doing them in most situations, even for yourself. With the fact that beneficiaries now don't have a life expectancy stretch in most circumstances and have that 10-year maximum they can take it out, that expedites the amount of tax they're going to pay, because they're taking out larger portions at any given year on the pre-tax accounts. But when you look at the statistics, most people inheriting these accounts tend to also be at the prime of their earning potential when they inherit, which means they're already going to be in a higher tax bracket than you might be yourself in retirement. That's, again, not always the case. It's worth doing that analysis with an accountant on. But if it is the case that maybe your son or your daughter is a physician or an attorney or somebody making a good amount of income, and you are in pretty, comparatively anyway, lower income brackets because of your retirement income being lower than maybe what you were earning as a salary, it might make a lot of sense to start converting some of that to a Roth, because the kids are going to be absolutely nailed with the taxes then when they have that 10-year stretch on top of higher earning potential than you have in retirement, maybe. So Roth conversions make a lot of sense to minimize the taxes for you for the higher RMD age, because again, you also have a shorter life expectancy than you did under a 70.5 life expectancy, or under even the 72 life expectancy, right? 75 is shorter, meaning you have to take out more at once. But it's especially beneficial for beneficiaries who are going to have 10 years for most individuals. There can also be some really good long-term care planning benefits on Roth conversions, and that is a topic we'll go into a lot of detail on next week as well, but just to touch on it briefly here for you. When you're doing long-term care planning around like concerns around nursing home expenses or assisted living expenses, there's a lot of prospective planning you can do to protect assets like real estate, just traditional investment accounts, life insurance policies, cash accounts, things like that, without any major tax implications for doing it. With retirement accounts, though, you can't do those types of transfers to like an irrevocable trust or to the kids without getting that tax hit. So it doesn't often make a lot of sense to prospectively transfer over any retirement account assets, or take withdrawals and transfer them over in most situations prospectively, because you're taking a tax hit that you might not otherwise need to take. So one thing you can do with that is, when you're trying to plan for how do I potentially maximize that protection later on, again, the more that you have post-tax, the less the tax implications are going to be at the time you go into care and maybe need to transfer some of those assets over if that's what you're trying to do. So Roth conversions can also be a really good long-term care prospective planning tool. So one really important way that especially if you have charitable intent in your lifetime giving or maybe at death giving, one really beneficial way to minimize the tax hit on these types of accounts is to leave the value of these accounts to charities, or to leave some portion of the value of these accounts to charities, especially the pre-tax IRAs, 401ks. So there's a couple different ways you can do this. If you do give during lifetime and you want to continue giving during lifetime in a very tax efficient manner, especially once you have to start taking your required minimum distributions. If you feel that you don't need to take or to receive that required minimum distribution, if it's just adding to your tax burden and you're comfortable living off of other sources of income, one thing you can do is you can give that required minimum distribution up to about $100,000 directly to a charity. It never comes to you. And that's what's called a qualified charitable distribution, a QCD. So if you already give money to a charity, you already give money to your church or your faith-based organization or some other community organization that is a nonprofit, you can do that directly from the IRA, and it actually takes the place up to, like I said, up to $100,000 of your required minimum distribution. So most required minimum distributions, unless you have a very large retirement account, aren't going to exceed that amount anyway. So a lot of people can just completely shift over the RMD to that charitable giving instead and not pay tax on it. It's less tax efficient to take the RMD yourself, then give money to charity and have to then file a deduction on your tax return rather than just have it be directly given and no taxes paid on it then. So QCDs are great if you have lifetime giving that you want to continue and you want to do it in a very tax efficient manner. But then of course, there's also just leaving the account itself to certain charitable organizations at death. If you would want to give to a charity at death as opposed to during lifetime, what you would ideally want to do is shift as much of your estate as possible that's pre-tax or would it be taxable to other beneficiaries. Maybe if you have a split between charities and individuals, which is often the case, you'd want as much of the retirement account as possible being used to satisfy the charitable intent. And there's a couple different ways to do this. Of course, you can actually do it through your trust, for example, where you're shifting certain income producing assets over to that side of the trust. But you can also just give directly as a payable on death, transfer on death from these pre-tax accounts directly to the charities of your choosing. Now, when you do it that way, you of course have to make sure that that's the exact amount or percentage of your estate that you would want to go over, because those accounts fluctuate too. So if you would say, well, I want 60% of my estate to go to charity regardless of the value, it's going to be a little harder to do that math when that account is fluctuating all the time rather than if it did pass directly through a trust first. But again, if you're just saying, I just want to minimize taxes, and so I want whatever's left in this account to go over to a charitable organization, it's a really tax efficient way to do it because they don't pay taxes on those accounts. They'll liquidate it right away and they'll use it for their charitable and their organization's purposes, and your beneficiaries won't have to pay any tax on it. Because they themselves did not receive it and have to take out any money. Now, with Roth accounts, you would ideally, if you're leaving anything to individual beneficiaries, those would be the accounts you want to go to the individuals because, yeah, that's very tax efficient for them too. They're not going to pay tax on it. And this it depends a lot on the company that you have your account through, your retirement account through. Some companies will allow pecuniary or specific dollar amounts to be given directly from retirement accounts at death. Not all do. So if you say, well, I would only want $100,000 to go to charity, and I don't want a certain percentage of my IRA to go to charity, you have to check with the custodian of that account to see whether they'll allow that type of designation. A lot do, not all do. So just be aware of that, but it is a possibility as well. With kind of going back to the long-term care component of these types of accounts too, and maximizing the value for individuals, one very efficient way to pay for long-term care, if you're an individual, a single individual, or even if you're potentially a married individual or married spouse that's going into care, when you're paying for long-term care expenses, whether that's assisted living, skilled nursing, things like that, those tend to be unreimbursed medical expenses. If you don't have long-term care insurance, you can tax deduct anything above 7.5% of your adjusted gross income from your taxable or from your tax liability. So when you have a pre-tax retirement account, things like an IRA or 401k, and you haven't done that Roth conversion, and maybe you have to pay for 1 to 2 years of care because that's what the facility is requiring, the most tax efficient way to do that is to use that pre-tax money for that payment. So if you have to pay that amount of money anyway, you might want to use some of that pre-tax money and maybe draw it down faster than you otherwise would through like just a bank account, because you're not getting that tax deduction from a bank account. It's not necessarily income producing as you take anything out of it. Yeah, there might be interest on it, But when you liquidate money from an IRA or you withdraw money from an IRA, there's a tax liability for anything you've withdrawn if it's not a Roth. And so using that money to pay for an otherwise deductible expense can be a very tax efficient way to use it. But if that's not what you're looking to do, another really important thing to at least consider, depending on your age, of course, is to look into long-term care insurance to help protect the value of that retirement account. And this is in particular very important for married couples, because when one spouse goes into care and the other spouse is still, maybe living in the home, the spouse who's living at home, their retirement accounts, IRAs, 401ks, whether they're Roth or traditional, are exempt from their spouse's available assets for care for Medicaid purposes. So that means that if I'm living at home and my spouse is in care, at some point down the road, I could keep all of the IRAs that I have in my name, whereas the rest of the spouse's IRAs that they have would be available. That doesn't mean they have to spend all of that money down and that I couldn't keep any of it potentially, but it does mean that some of it will and a lot of it will potentially. So when you're looking at how do we protect the value of that, one of the things that you can look at is using long-term care insurance. Maybe you cover both of you. That's great if you can do that. But if you feel, well, it's too expensive for both of us, one thing you might want to look at doing is protecting the spouse who has the larger retirement account values from long-term care expenses. So when I see a couple come in and I see one spouse has a lot more in their retirement account than the other spouse, and they're kind of going back and forth on long-term care insurance, one thing I suggest is, well, I would obviously recommend that you look at it for both of you because that way you can make the decision on it. But if you feel that you can only afford one policy or that you just don't want to pay for more than one policy, it's better for you to cover with long-term care insurance the spouse who has more in their retirement accounts, because they're the one who would be the most at risk if you went into care, because more of their assets would be available for care than if they were the healthy spouse. So it can be something to look into. And then there are also ways, if you're going into care, and one spouse is going into care at the time, to shift the value of those accounts, or at least a significant portion of the value of those accounts, over to the spouse who's still living at home and is still in better health. They're not in need of care. That's what we would refer to in Wisconsin as the name on the check rule. Wisconsin says that spouses living at home, the ones not in need of Medicaid, can keep all of the income coming in their name. And so what we can potentially do is shift the IRA from the spouse who's going into care, and be kind of annuitize it as an income stream for the healthy spouse. And these have to be set up properly. These are not just any annuity that you could go out and buy, but it does provide a way to shift some of the value of those accounts over to the community spouse, the one living at home. Now, what's very important to know about that is that in order to do this type of planning, if the spouse who's in care has lost capacity, is you really need to have very well drafted powers of attorney for finance that allow these types of transactions to occur on that person's behalf. If they don't include these authorities in those documents, you're going to run into a lot of problems when it comes time to make these shifts. So there's a lot of things that you can do with retirement accounts or on long-term care, whether that's prospective planning by doing some Roth conversions and getting as much of it post-tax as possible, or using it directly to pay for cost of care because it's a one-for-one exchange, or potentially shifting it over as an income stream for the community spouse. Just know that there's things that you can do to protect it, but one thing that you really want to be careful of is making sure that both you or you and your spouse have good powers of attorney in place, well-drafted powers of attorney that include all of these types of authorities. Because if they're very basic, very general, like the statutory form is, where it says my power of attorney can do banking for me, that's not going to be good enough to cover that potentially, and you just need to be careful. So I'm running out of time here and I don't see any questions. So just a couple quick things again before I leave you for the day. But again, keep an eye out for that email at the end of this, where you'll get that sort of comparison chart from pre-Secure Act and post-Secure Act changes. And some of those changes have not been updated, I don't believe, for the Secure Act 2.0. So it's like the required minimum distribution age might not quite be fully up to date at this point. But Keep an eye out for that. And then also that feedback form where if anything we've talked about today makes you want to come in and talk to one of us and sit down for an initial consultation, please feel free to fill out that feedback form. Again, those are complimentary initial consultations. We do schedule them for about 2 hours, so to give us plenty of time to address your concerns. And otherwise, if you're interested in hearing me talk more about retirement account planning and maximizing value of your retirement assets in relation to long-term care more in depth, that's what I'll be talking about next week at the same time. And then the following week, just as one last reminder, is our in-person Wills versus Trust public seminar at the Bordini Center through Fox Valley Tech here in Appleton. So that'll be March 15th. We do the 2 sessions for that, 2 p.m. and 6 p.m. And you can sign up for that at estateplanninglive.com. But otherwise, I hope you all have a great day, and I look forward to seeing you next week.